Here is why today's stock market decline matters right now. The Dow, S&P 500, and Nasdaq opened lower this week, led by sharp declines in Nvidia and Tesla, two of the most influential tech names. While the S&P 500 remains neutral at $6,899.02, broader sentiment reflects growing uncertainty ahead of key economic data and evolving global dynamics. This pullback isn't isolated. Global markets are reacting to a confluence of factors, slowing tech growth, tightening financial conditions, and shifting investor risk appetites. Notably, gold fell 4.4% to $4,327.04, while Bitcoin dropped below $88,000, a sign of broader risk-off behavior. Institutions are recalibrating positions, balancing short-term volatility against long-term strategic goals. The context? Geopolitical tensions persist, and central banks remain cautious. The Federal Reserve's dovish pivot last month hasn't fully reassured markets, particularly as inflationary pressures resurface in energy and commodities. Eurozone debt concerns and U.S. China trade frictions are amplifying caution, pushing investors towards safer assets or away from equities altogether. For institutional portfolios, this shift underscores a critical inflection point. The bearish trend in gold, euros, and BTC signals waning confidence in asset bubbles and heightened demand for liquidity. Traders must weigh immediate downside risks against potential rebounds in sectors like healthcare or consumer staples, areas where defensive positioning could yield alpha. From a technical perspective, the S&P 500's near-term resistance at $6,950 remains a psychological hurdle. Volume trends suggest institutional buyers are accumulating at support levels, but momentum indicators hint at a potential consolidation phase. Our models show a high probability scenario of a shallow rebound by mid-week, driven by corporate earnings season and Fed policy whispers. If this analysis was valuable, subscribe for more institutional insights. Link in bio.